if you know compound interest tables, you could do very well over, with a smoother ride over a long period of time. One of the best examples, and when I taught those ninth graders, I actually put on the outside of their notebooks, I handed them notebooks, and on the outside I had a compound interest table, and it had the example of starting investing $2,000 a year when you're 19, in your IRA until you're 26. So 7 years of putting away $2,000 and never putting another nickel in again. Or starting when you're 26 and putting in $2,000 a year for 40 years until you're 65. So the people who put in $2,000 a year from age 19 to 26 and never put in another nickel ended up with more money. If you earn 10% a year on that money, they ended up with more money with those 7 payments than the people who started 26 and put in 40 payments till they were 65. You end up with more money, the 19 to 26. Just a very important lesson to learn about starting early. I know all of you are over 19, so I'm sorry I didn't tell you this. but these kids weren't, and so compound interest tables are important. So you're young. If you stay with a very methodical investment strategy that makes sense over time, you can all still do very, very well. Well, information, people have information on the S&P 500 stocks. There's still a lot of groupthink going on. Some of these, what I tell my students is some of these smaller cap, what happens if you're very good at doing things like you can be a stock market genius and buy some of these things in these obscure places, and what I would call it is taking unfair bets, not because you're so smart, but because you found it in a place that other people aren't looking. What happens to people who get good at that is they get a lot of money and then they can't do that anymore because they have too much money. So it opens a whole new area for young people to keep coming into that. So certainly some of the smaller situations will always be there. Things may be a little more efficient, but there have been plenty of studies. One of the big chapters I wrote was on spinoffs, which are companies that are sort of separated from. And those still work very well, but it sort of misses, they've studied, like if you bought all the spinoffs, how would you do? And they continue to outperform. That's not really the question. The question is this an area ripe for mispriced securities? If the average spinoff did average, that wouldn't mean anything to me. You're looking for the opportunity where people are discarding things or just not interested in things for reasons that don't have to do with the investment merits. They may be too small. It may not be the company that the people who own the original stock invested in. Usually you discard companies that are out of favor at that time. So even though on average they've continued to outperform pretty much as well as when I wrote the book, so that's not discouraging. But even if they did average, they still are ripe for mispricing, really what I'm looking for. So you're looking in these areas that are ripe for mispricing. You don't have to run a statistical model to decide whether on average they do well or they don't. If you know what you're looking for opportunities to find things that are mispriced, and I don't think those will go away. But as I said, there are higher and better uses for most people's time. So I had a ball doing that. I have a ball doing what I'm doing. If you don't want to do it, fine with me. Well, I'll pick Apple as just big picture. You guys have heard of that? Yeah. So, at least I'm old enough to have had a BlackBerry, and it used to have 50% of the market. Now it doesn't really exist. It wasn't that long ago. And some people, and the vast majority of Apple's profits come from their phone. So that's the negative story on Apple. It's a hardware company. It's going to crash and burn like all of them do. Okay? On the other hand, some people might say it has an ecosystem of products that play off one another. They interact with one another. It has a brand. I always say, hey, Coca-Cola doesn't make sugar water, and they, have kept their brand pretty well. People tend to like Apple has a brand, and so the question is, which is it? Is it Apple a hardware company, or is it an ecosystem of products with a great brand name? I'd say the answer is probably gray. Somewhere in between. It's not either one. It's probably somewhere in between those two. But if you took a look at the market, I can look at where the S&P is trading. I can look where Apple's trading. And a few months ago, it's still very cheap, but a few months ago it was trading at less than half of the valuation of the S&P. So at a price, my answer is, if it's somewhere in between, I'd say it's probably better than average, and I'm getting it at half price. I don't know if that's right, but I have a large margin of safety. I own hundreds of what I say is what we do now is, I don't know the answer to your question. It's gray. I don't know the answer. I don't know if it's closer to hardware company. I don't know if it's a ecosystem with a brand attached, and so it's much, much better. But interest rates are 2%. It's got a 10% free cash flow yield, earns high returns on capital. It's got a great niche. What I would say is, I don't know if Apple's going to work, but I don't own just Apple. I own a bucket of Apples. I own a bucket of companies with metrics like that, trading really cheap, with deploys capital well, with nice potential prospects. And so I don't know if Apple's going to work. I know my bucket of Apples is going to work. That was the chart I showed you. And so we own the bucket of Apples. Mm-hmm. But if you ask my bet on Apple, I think it's cheap relative to other choices right now. Well, I told you where I thought the market in general, it's a market cap weighted index, the S&P 500, was expensive, but still expecting positive returns going forward. It's a world of alternatives. So the question is, how should I invest my money? The move to passive can cause, with all the ETFs and everything else, can cause dislocations in the short term because people are not discerning. Each company, remember I said stocks are not pieces of paper that bounce around that you put Sharpe ratios and Sortinos on. Their ownership shares of businesses. And businesses, there's a dispersion in their fundamentals, how one's doing versus another. When you just take an ETF and don't discern between the differences in the fundamentals, that can cause dislocations in the short term. That just makes me smile more because those dislocations mean, hey, I can find bargains because people stop thinking. But I don't think they're at such an extent that other than in the short term, I think you're familiar when the market falls and everyone gets depressed all at once. They say correlations go to 1. That just means everyone throws the baby out with the bathwater. They don't make no discernment. But that really just happens for the first month, maybe 2 at the most, and then there starts to be discernment. That's actually the best opportunity time for us. When people start discerning again and you just had everything move together, which it shouldn't. They all have different prospects.